Well, join us now in studio to look ahead on what may come in 2025 for the economy and investors. We have RSM Chief Economist Joe Brusuelas. Joe, always great to see you and on set.
Good to see both of you. Happy holidays and Happy New Year.
You as well. I was just talking to Sam Stovall there about the 10-year, which is backed up to 4.62. There's some debate, Joe, and here's where I want your insight as to why we backed up to 4.62. Is it the economy's resilient, inflation's maybe a bit stickier than we thought? Is it, investors actually getting a bit more concerned about our fiscal challenges? Is it all of the above?
All right, it's looking like the economy is going to grow at a 3% pace in the second half of this year. And inflation's just stubborn and sticky, especially in the service sector, which, by the way, inflation is still increasing over 4% there. And we have yet to see that material abate. And then there's the uncertainty tax due to the major changes that are coming next year. So it's spooked the market a little bit. I don't want to make too much around today because we got thin trading conditions. Our forecast for next year was we would see an average of 4.5%, right? We thought it would trade mostly between 4.3 and 4.70 with an occasional foray up around 5%. But that's where we think things get a little shaky. Remember what happened the last time the 10-year yield moved above 5%, March 2023, the mini banking crisis, local and regional banks holding a disproportionate amount of CRE portfolio loans. Fed had to step in and ring fence those banks, and then things materially improved. So I think Sam's right. We're going to see a good to and fro next year. We were very pleased with where we were this year. Our forecast was 4.2. Before I came in today, I looked, it was at 4.1 on average for the entire year. We've got a number of models. We're very confident. I do think it's a little oversold here, to be honest with you. The economy's strong, but not that strong.
Well, you talk about inflation being sticky, and it's interesting how quickly the narrative has shifted since the election. Still a lot of unknowns, obviously, going into next year, but how do you sort of look at that piece of where we are right now and the potential for tariffs to tack on additional?
So our analytical framework for the past couple of years has been regime change, right? That the pandemic wiped the slate clean, and we've got a more inflation-prone economy due to all sorts of structural changes domestically and globally, right? So we think that this economy is growing at a much faster pace than the long-term trend would otherwise suggest. We had a 55% probability of a 2.5% growth next year. But for the first time in years, guys, the alternative is not a recession. The alternative baseline is a 30% probability that the economy grows above 3%. At that pace, inflation's not coming back down, the Fed's not cutting rates. And we're in a very different world, especially around tariffs and perhaps some tightness in the labor market due to immigration, perhaps later next year or into 2026. So our framework looks pretty good right now. I'm even surprised a little bit that the economy just refuses to slow.
And what explains that? What explains that, Joe?
Okay, there's three big things. First, the household just continues to outperform. You guys saw the spending around the holiday. We're going to exceed forecast, right? Second, businesses are investing in themselves. The connection between the fundamental condition of the real economy and equity markets is obviously technology. Those chips are going to be put into work. It's going to enhance and boost productivity. That's really good. That's what you want, right? But policy may not be particularly aligned well to where the economy is and where I think it's going. Then the third thing is we got one hell of a fiscal tailwind behind us, right? The CHIPS Act, right? Infrastructure, the Environmental Sustainability Act, which they call the Inflation Reduction Act. Right? All those things are working. We just got a really strong tailwind right now behind this economy, and the Fed basically gave up the game at the last meeting. About basically, it's like inflation's just not behaving as we thought it would, neither is the economy. They threw in the towel, and now we're back to a more finely tuned balance between labor and inflation.